Well, stocks continue to trade in a narrow range. On Monday, the S&P 500 closed ahead 0.3%. That was enough to push the broad index to a record high, and investors are now looking for the next big catalyst to move the markets higher or lower. And here to break this down for us is Kevin Kelly, the Chief Investment Officer at Recon Capital Partners. And Kevin, what do you make of this pretty tight range we're in? It's frustrating for investors, right?
It's very frustrating. This entire market is predicated on the Fed, right? So we've had great job numbers and we've had inflation, albeit on the asset side. We're talking about the S&P 500 at all-time highs. So what really is driving the market and the action is actually in the overseas markets. You know, we're getting news all the time over there. They're starting to do quantitative easing. A lot of the numbers are getting better. So they're actually driving the market. So in the U.S., it's going to be next earnings season that's really going to move the stock market.
So you think earnings, second quarter earnings, is the next big catalyst. Why is that?
One of the reasons why we think next quarter is really going to push the market is because everything's already been baked in. The stronger dollar's been baked in, weather's been baked in. Now it's time over the summer for companies to execute on their business plans and actually grow their earnings and not have these excuses. So everything's been thrown in, including lower energy costs.
Yeah, the lower energy costs, the dollar's weakening, so those headwinds for earnings seem to be behind us, at least for right now. What about an event that could push stocks lower? Is the looming Fed rate hike one of those?
Yeah, that's a great question, and investors really need to focus on these yield companies, right? So you need to look at utilities, REITs, consumer staples. They're trading at higher multiples than their normal averages. So if we do get an increase in rates, we could see their multiples compress from 19 times PEs to 17 times PEs or even lower as people trade out of those yield companies and into other fixed income alternatives.
And that could have a negative effect on the markets overall?
Entirely. That's what happened to energy stocks when oil dropped. You saw the entire complex come down. That could do the same effect with these yield companies.
In your opinion on a rate hike, we're looking at September?
Yeah, I think we're absolutely looking at September. One of the reasons why is because the Fed won't want to start making moves towards the holiday times. And in 2016, it's an election year, so they'd rather get it done sooner rather than later, and September is probably the time frame.
And just real quick, give us a sense of where you're finding value in today's markets, maybe areas you're trying to stay away from, names you like?
Yeah, so as we saw, staples and consumer discretionary are expensive. The names that have worked all year are those technology company names and healthcare. So it's focusing on those, but got to be choosy. As we saw from Twitter's earnings, LinkedIn earnings, you need to be choosy.
All right, Kevin Kelly from Recon Capital Partners. Thanks for coming in.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.